Hi guys, welcome back to the channel. I'm Dilip. I'm sure you all might have heard about overnight trading gaps, but have you ever heard of intraday trading gaps? Less likely. Intraday gaps are formed within a day during trading hours. Here in this video, we will discuss how to identify these intraday price gaps using order flow and its significance in intraday. And lastly, we will understand how to take advantage of them. So first, let's understand what a gap is. A gap is a missing piece in a stock price chart caused by a lack of trading activity in a specific price range. So if you look at here, there is a gap up opening on the next day. So previous day, the prices have closed somewhere around 49,400 and the gap up opening price is 49,500. So this we call it as a overnight trading gap. These gaps typically happen due to a significant shift in market sentiment when the markets are closed. So you might ask, when the price is continuous, why in intraday there will be gaps? Let me explain you this. This is the DOM where buyers and sellers have placed limit orders. Unless a market order or a limit order specifying this price, the prices won't get executed. Same thing, unless a buy market order gets hit this best ask price 1001, prices won't go up. In general, sellers want to sell at higher prices. So as the prices goes up, more number of sellers will be at higher levels. Same with buyers, as the prices goes down, more number of buyers will be at the lower levels, because lower prices attract buyers. If you take Nifty and Bank Nifty, the minimum tick size is 0.05. So you can only place the orders in the multiples of every 5 paise, not below that. Look at here. So there are 3 orders here. It is in multiples of 5 paise, this and this. Unless you are a market maker, most of the people, they place the orders to the nearest round number. So let's say there is a limit order book here, it's full. So there is a market order who comes into the market and price shoots up, eating away all the DOM ask prices, creating gaps like this. So these gaps are negligible, but what is important is our bigger gaps, let's say 5 points, 10 points. So those gaps are very much important. These intraday gaps give good trading opportunities for a trader. So here if you look at, so as the prices approached 47,900, there was a pretty big sell order. So the moment they place a market order, it goes and chases all the DOM orders that are resting in the limit order book. So 1.9k got executed here. There was a gap here, which means there are no orders at all at this point. And so almost 80 points, there is no orders at all. So it's a pretty big gap. So what happened next? The prices started coming all the way, filling the gap, whatever is there. When it comes to intraday gap, treat them as a normal gap. When understanding intraday gaps, you need to understand there are 2 types of gaps here. So one thing is, when a market order skips the price, it will create a gap like this, where there won't be any orders on the both sides. Sometimes what happens, you will see market orders getting executed on the right side, but you will see continuous zeros on the left side. Those are limit order gaps. So let me show you an example, this one. So for 10 points, there is no limit orders. So these are limit order gaps. Consider these gaps as good as any overnight gap. So these gaps, they act as a very strong price magnets. For a green candle, you look for limit order gaps on the left side. For a red candle, you look for limit order gaps on the right side. So there is a gap here of 40 points, and then immediately the prices started covering this gap. So these gaps happen mostly in volatile instruments, which is a characteristic of less liquid stocks or indices like Bank Nifty, Fin 50, Sensex, commodities. So look at this again. So there is a good amount of gap. So this gap created by strong selling imbalances. On the next day itself, it got tested. Look at this example. There is a good amount of almost here 60 points, here 20 points limit order gap. So prices went up because of strong buying, and at some point the buyers have lost the momentum. Prices started coming down. There was a strong aggressive selling on the left side of the candle, and the prices started covering the limit order gap that has been created. Same thing here. There is a good amount of limit order gap. Once the buying momentum is lost, so despite of 4.7k, look how the prices is closing. So this says that strong delta is there, but the price is not closing accordingly. There is a limit sell order which is absorbing the market buy orders. Once the buyer lost their capacity to buy more, the prices reverts back to these gaps, whether it is a true gap or a limit order gap. Also remember this point. So if there is only one zero, it's of less significance. If there are more number of zeros created in intraday, most likely it will get revisited. So look at this. As I said, so more number of zeros is there or good amount of gap is there, most likely it will get revisited. This is with intraday gap, guys. If you like the video, don't forget to subscribe to the channel and like this video. Thank you. Have a nice day.